In today's episode of the Daily Brief, I'll talk about two interesting stories. I'll first talk about how the world can't have enough of copper, and then I'll talk about the nightmare quarter for IndiGo. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Tuesday, 27th January. Coming to the first story. If you've been seeing copper prices surge lately, you might have been wondering, what's so special about good old copper? So, copper's best trait is that it carries electricity very efficiently while not corroding easily. It's effective and long lasting, which is perhaps why it's used in every modern electrical appliance today, from a light to a toaster to a smartphone. But beyond that, copper has also become a foundational metal for many new technologies like EVs, wind turbines, solar panels, power grids, data centers, and so on. An EV, for instance, uses a whopping 80 to 90 kg of copper on average, 4 times that of a normal car. Every country in the world is trying to electrify transport, decarbonize power, and digitize its economy, which ends up demanding more copper. And there's no easy substitute for it. Some make the argument that aluminium can replace copper, but that's difficult. In high performance electrical systems where efficiency and heat resistance matter, aluminium can't do what copper can. Silver might be the next best alternative to it, but it's too expensive for everyday use. On top of that, silver prices are having their own moment anyway. Now, this insatiable demand for copper shows up in its sky high prices. The global benchmark price for copper is set on the London Metal Exchange, commonly referred to as LME copper. Over the past year, copper prices have risen sharply and even crossed the $13,000 per ton mark. As of January 2023, prices hover around $12,800 per ton, levels that were once considered extreme. And these prices are not being driven by speculation alone. They reflect a deeper structural tension between how much copper the world needs and how difficult it is to produce more of it. So, to understand why this tension exists, it helps to look closely at how copper moves from deep underground into the objects we use every day. So, copper begins its life deep in the earth as part of a rock. Copper is usually spread thinly through vast quantities of ore. The concentration of copper in this rock is known as the ore grade. Decades ago, some of the world's best copper mines operated at ore grades of 1.5% or higher. That means 1.5 kilograms of copper for every 100 grams of rock. Today, many new mines operate at grades closer to 0.6% or even lower. Far more rock has to be dug up and processed to extract the same amount of copper. Now, when a copper deposit is discovered, the richest and most concentrated parts of the ore body are usually closest to the surface and easiest to access. These high-grade zones are mined first because they deliver more copper with less effort. Over time, those zones get depleted, which is why new ore grades are declining in copper material. And the deeper you go, it seems, the lower the copper concentration gets. So, as mining goes deeper, the amount of surrounding waste rock, often called overburden, also increases. For every ton of copper extracted, miners must drill, blast, haul, and process much larger volumes of rock. The visible result is more debris, larger waste dumps, and bigger tailing ponds, even though the final copper output may remain the same. Globally, copper reserves are concentrated in a few regions. Chile is the undisputed leader, followed by Peru, the Democratic Republic of Congo, China, and then the US. Many mines in these countries are aging. As mines get deeper and ore grades fall, costs rise and environmental challenges increase. Mines are also increasingly shut or delayed due to water shortages, environmental protests, labor disputes, or changes in government policy. And this has made copper supply far more fragile than it appears on paper. Once copper is mined, it's crushed into smaller pieces and processed to separate the copper-bearing material from the rock. In most large deposits, copper is present as a sulfide mineral, and this material undergoes a process called flotation, which uses water, chemicals, and air to separate copper concentrate from the rest of the rock. Now, this stage is extremely water intensive. In dry regions like Chile, water scarcity has strongly constrained copper production. The output of this stage is copper concentrate, usually containing 25 to 30% copper. This is not yet usable metal, so it must be transported, often across continents, to a smelter to be processed. At the smelter, the concentrate is heated to very high temperatures to remove sulfur and other impurities, and this process produces blister copper, which is approximately 98% pure. The blister copper is then refined, typically using electrolysis to produce copper cathodes with nearly perfect purity. These cathodes are reddish metal plates that weigh approximately 50 to 80 kg each, and this is the form in which copper is traded globally and priced on exchanges like the NME. From cathodes, copper is drawn into rods, wires, tubes, and sheets, eventually ending up inside homes, factories, vehicles, and power infrastructure. Now, where's the money in this entire chain of activities? Copper mining is one of the most capital intensive and time consuming industrial activities in the world. The whole process from discovering a deposit to producing the first ton of copper can take up to 20 years. Besides enormous amounts of capital, it also involves geological surveys, environmental approvals, land acquisition, drilling, and so on. A miner might spend billions of dollars for years, even decades, before earning a single rupee. Perhaps it's because of these huge risks that most companies only get interested in mining when copper prices are high. By that point, the economics look attractive on paper. But mining projects take many years to build. So by the time new supply finally comes online, copper prices often have cooled, leaving companies with large investments that arrive too late in the cycle. The economics of copper smelting, on the other hand, don't benefit as much from high copper prices. Their margins depend on something called treatment charges and refining charges, known collectively as TCRC. So, when a miner produces copper concentrate, it sells that concentrate to a smelter. The smelter charges the miner a fee for processing the concentrate into refined copper, and this fee is the TCRC. When there are many mines and limited smelting capacity, smelters have bargaining power and can charge higher TCRC. But with many smelters chasing limited concentrate, miners gain the upper hand, suppressing TCRC. In today's world, smelting capacity has expanded faster than mining capacity. China, India, and parts of Southeast Asia have built large smelters, but new mines have lagged. As a result, smelters are competing aggressively for concentrate, and this has pushed TCRC to bedrock low levels, squeezing smelter margins even with high copper prices. In the last 10 years, TCRC rates have fallen from approximately $100 to approximately $20. Now, this dynamic explains why mining companies often benefit more directly from rising copper prices than smelters do. And it also explains why countries that lack domestic copper mines remain vulnerable even if they have large refining capacity. Smelting, by contrast, is faster and easier to scale. A smelter can be built in 3 to 4 years. And this has led many countries, including India, to focus on refining rather than mining. But without secure access to concentrate, smelters remain exposed to global supply disruptions. And this brings us to India's position in the copper ecosystem. So, India consumes around 1.8 million tons of copper each year. And demand is growing steadily as the country builds power grids, rail networks, renewable energy capacity, and electric vehicles. However, India has very limited copper reserves. Our known deposits are small, low grade, and geologically complex. As a result, domestic mining produces only approximately 50,000 tons of copper annually, a tiny fraction of national demand. Hindustan Copper Limited, or HCL, a PSU, is the only vertically integrated copper player in India. It owns most of the country's operating copper mines, accounting for half of India's known reserves. However, HCL has long struggled with operational inefficiency. A detailed report by the CAG highlighted issues ranging from delayed mine development to poor capacity utilization and cost overruns. Despite owning valuable assets, HCL has not been able to scale production meaningfully. For years, India compensated for weak mining by importing copper concentrate and refining it domestically. So, this allowed the country to be a net exporter of refined copper even without a strong domestic ore supply, similar to how we refine oil. That changed dramatically in 2018 when the Sterlite copper smelter in Thoothukudi, India's largest copper smelter at the time, was shut down following protests and prolonged legal challenges. The plant had a capacity of approximately 4 lakh tons per year. So, with Sterlite gone, India lost a significant portion of its midstream capacity almost overnight. Since then, the country has turned into a net importer of copper cathodes, relying on overseas suppliers to meet a gap that domestic production could no longer fill. And then there's Hindalco, the metals flagship of Aditya Birla Group. It operates a large important smelter at Dahej, but its capacity alone has not been sufficient to bridge the gap. Meanwhile, HCL's smelting and refining operations are relatively small compared to its mining. Now, more recently, Adani has introduced plans to enter copper refining with a large smelter project targeting an eventual capacity of 1 million tons per year. While this could significantly reshape India's copper landscape, such projects take time to ramp up and will still depend heavily on imported concentrate. Even with this primer on how the global copper supply chain works, we've barely scratched the surface. Globally, the copper industry is entering a period of consolidation and strategic repositioning. Major miners are merging, governments are reassessing resource policies, and even technology companies are getting involved. Hyperscalers like Amazon, which build massive data centers packed with copper intensive equipment, are exploring long term supply agreements and even direct exposure to mining assets. At the same time, recycling is gaining importance. Copper is infinitely recyclable, and recycled copper requires far less energy than primary production. However, in countries like India, recycling remains fragmented and informal, limiting its ability to meaningfully offset import dependence. The world needs more copper than ever before, and producing it is getting harder, slower, and more expensive. For India, this challenge is sharper. Our appetite for copper is too high for our current capabilities. So, unless mining efficiency improves or overseas partnerships expand, India will remain exposed to global supply shocks. Coming to the second story. We've been covering Indigo's quarterly results for a while, but in none of those rounds did we come to it with the sort of morbid curiosity that we did this time around. To this point, the airline was the unquestioned star of Indian aviation with a market share so high that it became a proxy for the entire sector. But then it went through the worst crisis it had ever seen. As the airline learned the hard way, a reputation built across decades can evaporate in the space of mere days. Naturally, going into this quarter's results, we had many questions. Would the company really talk about what happened? What is the scale of impact that an incident like this has on an airline of Indigo's size? And looking out ahead from here, should you just adjust your assessment of the company? We are not sure we have all the answers, but here's what we learned. On paper, Indigo's operating revenue grew last quarter, rising by a little more than 6.2% since last year to around rupees 23,500 crore. Its operating cash flow too was in roughly the same territory as last year. The company's EBITDA, the cash it earned before paying tax, interest payments, leases, and wear and tear costs, dropped by just 0.8% to roughly rupees 6,000 crore. Its profit numbers, however, is where the dents begin to show. They collapsed by nearly 78% compared to last year, coming to just rupees 550 crore. The company claims that if everything had run according to plan, it would have earned a profit of over rupees 3,100 crore. But it took three severe hits. The biggest of these was the one that perhaps made the least noise: exchange rates. Indigo has major payment obligations in dollars. For instance, many of its planes have been leased and these leases are priced in dollars. With the rupee declining massively over the quarter, its future payment obligations ballooned. Taking that into account, the company had to book a massive paper loss as a result of over rupees 1,000 crore. And then there were the labor codes. As we've written before, the new labor codes changed how most companies calculated the wages they pay. Suddenly, the amounts that they had previously kept aside for gratuity and leave encashment were no longer enough, and they now had to keep aside a lot more money. This was another paper loss, a one time provision of roughly rupees 960 crore. The lowest hit of the three, though still massive, came from the airline's December crisis. The company has provisioned a loss of roughly rupees 580 crore. We'll come back to that soon. These are one time hits, all things considered. For all the bad news around the airline, it isn't in any sort of existential crisis. If this quarter is a disappointment, it's so because of what was expected going in. As recently as November, Indigo expected to grow in the high teens in this quarter. It was on track to add tremendous amounts of capacity to meet all the new festive season demand it thought it would see. Meanwhile, its costs seemed under control and all else staying the same. This should have been a quarter of sharp growth. As it turned out, that expansion did come to be. Indigo added 23 new aircraft to its fleet, And this meant that its average seat kilometers, a unit of how many people it could fly for how long, went up 11%. Its unit costs barely rose, and its fuel costs, relative to how much it flew, actually came down a little. In theory, its revenue should have grown substantially. But perhaps because of all the chaos of the quarter, the passengers didn't show up. The company admitted to a subdued booking curve after the incident tripped through its operations. Compared to the 11% jump in flight capacity, its passenger numbers were up by less than 3%. As a result, the airline flew emptier planes with its passenger load factor dropping by 2.4%. This brings us to the elephant in the room, the catastrophic failure that kept the airline in the headlines for weeks on end. At the height of the crisis, in less than 10 days between December 2nd and December 10th, 2025, the airline cancelled approximately 4,500 flights. The worst of these was December 5th, when less than 4% of the airline's flights reached their destination on time. IndiGo's dominance in India's aviation market in good times gives it incredible strength. But in this case, it backfired severely. As the airline's operations broke down, it turned into a nationwide transit emergency, leaving over 5 lakh passengers stranded. So, how did things get this bad? This topic has drawn a lot of speculation and innuendo over the last couple of months, and you've probably seen most of it elsewhere. Most of it is hard to verify, so we'll avoid mud raking, but here are a few things we do know for a fact. So, back in January 2024, the Director General of Civil Aviation, or DGCA, revised its norms around pilots' working hours through what are called the FDTL regulations. Among other things, these regulations added an extra 12 hours to pilots' weekly rest hours, and they also drastically cut down on the number of night flights a pilot could be expected to fly. So, to maintain the same scale of operations, it would seem, any airline would have to greatly increase the number of pilots on its roster. In all, airlines had until November 2025, the better part of 2 years, to adjust to these norms. It isn't clear where across this adjustment period the failure actually took hold. Even early last November, the airline thought the new regulations would do little more than causing a slight uptick in costs. When IndiGo first planned its schedule for the winter of 2025, it hoped to fly 10% more flights than last year, despite the new norms choking its pilot supply. But as the season's operations began, the strain was visible immediately. In November itself, the airline cancelled over 1,200 flights. Its on time performance took a severe beating. Early in December, though, a few additional ingredients turned this strain into a full blown crisis. For one, the airline's IT systems couldn't handle the new regulations requirements and kept creating illegal rosters. If IndiGo needed a workable schedule, it would have to prepare one manually. Meanwhile, two other crises, a global Microsoft Windows outage and a bad spell of fog across North India, completely scrambled the airline's running operations. The FTTL regulations had already stretched the airline, leaving no room for error. These new challenges became a knockout punch. For days, the airline was effectively flying blind. It completely lost track of its crew, where they were, and how much they could be asked to work. That was when things fell apart. A large part of the company's investor call, as one would expect, revolved around the incident. The company acknowledged the mishap but didn't go into the details of what went wrong. It merely noted that it was carrying out an in depth review of the episode and how it could make its processes more robust. Many analysts asked whether the company had a shortage of pilots or whether it planned to hire more, but the company refused to say anything concrete. Instead, the company's focus was on what it did to recover from the mishap. Its focus, the company claims, was to expand its customer support. Its ground staff, operations teams, and customer service teams were brought back into work around the clock to ensure that things were up and running as soon as possible. This brought the airline back on track, and by December 9th, the worst was behind it. Soon, it was flying over 2,100 flights a day once again, carrying roughly 3.8 lakh passengers a day. So, how convincing is this? We aren't sure. The company claims that its on time performance, or OTP, was good by mid December, but it doesn't actually give any numbers for the month. In its financial press release, it only gave OTP data between October and November, which looked reasonable at 76.6%. December's data was omitted entirely. Either way, the episode put a serious dent on the airline's numbers for the quarter. It had to process a large number of refunds for the cancelled flights, and it also gave out lakhs of vouchers for future flights in what it called gestures of care. Some stranded customers were given accommodation and meals, and soon afterwards, the DGCA added a rupees 22 crore penalty on the company. The exact hit the company took from this episode isn't entirely clear. It was probably settling claims from irate customers well into January, and the vouchers it has given out could hit its earnings repeatedly over the next many quarters. Based on its estimates, though, the company made a provision of around rupees 580 crore to book all those losses in the December quarter itself. This incident, in all likelihood, will haunt the company into the future. Already, the DGCA has asked the company to fly 10% fewer flights, dampening the rapid expansion it had planned. It was also forced to vacate its takeoff and landing slots across many airports so that other airlines could take over. It isn't clear how long the pain will last, and according to its management, Indigo's sole focus right now is to make it smoothly through to February despite all the hits it has taken. Even the coming summer, it says, is too far ahead to plan for. It would be foolish to write the airline off, however. It is still by far India's biggest carrier. It continues to fly thousands of flights every single day, ferrying crores of passengers over the course of a year. December's incident might be an embarrassment, but it's not a fatal blow. Now, coming to the tidbits. Micron Technology will start commercial semiconductor production by February end at its $2.75 billion Sanand, Gujarat plant, marking a key milestone in India's chip manufacturing push. Coming to the next tidbit. Indian drug makers including Sun Pharma, Zydus, and Alkem have received regulatory approval to launch cheaper generic versions of Novo Nordisk's Wegovy and Ozempic ahead of the semaglutide patent expiry, intensifying India's obesity drug race. Coming to the final tidbit. Renault is reboosting its India strategy by relaunching the Duster and shifting focus to higher margin, middle class SUV buyers as part of its global growth push beyond Europe. You can check out all the links in the description. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.